Ladies and gentlemen, thank you for joining us for today's program on Does Norway Save Too Much with Governor Øystein Olsen, the non-Scandinavian American pronunciation. We're very glad to see so many serious people and old friends of the Institute and old friends of Norway and central banking in general here today. Obviously, there's a great deal of news being made down at 1600 Pennsylvania Avenue, as well as a bit of Norwegian climate brought into the last couple of days. But the long term of the world economy depends, as we keep trying to remind the Trump administration, significantly on capital flows and allocation decisions of savings versus investment, and allocation decisions by savers of where they put their money. And Norway, of course, both as through the decision of millions of individuals, but also through the sovereign wealth fund run by the Norges Bank, the Norwegian central bank, is making very important decisions that ripple throughout markets. We have had a long interest here at the Peters Institute, not just in Norway, where we're proud to have a relationship with the Norges Bank, but in two broad issues that intersect today. First, the issue of current account imbalances and official actions having to do with savings and currencies that affect current account imbalances. And of course, among many others, our colleague Joseph Gagnon has been leading in that work. And we released about a week ago and are promoting today his policy brief, Can a Country Save Too Much? The Case of Norway, which we, as Joe acknowledges, we are very grateful that our colleagues at the Norwegian Bank were very kind in giving substantive response in the drafting stage and information. Not complete convergence of views, but very healthy substantive exchange. We're grateful for that. We also, of course, have been following the issue of sovereign wealth funds and their governance for some time now, led by our colleague Ted Truman, who with some co-authors has produced a series of updates on on sovereign wealth fund governance principles and disclosure, where again, we're all quite pleasant, I'm not surprised, but quite pleased to see Norway ranking very high in our disclosures. So there are a number of things that can be discussed today, but in the context of such a fraught discussion in Washington about bilateral and global trade imbalances, it is extremely important, timely, and welcome to have the governor of the Norway Central Bank here to talk about this in a substantive way with a long-term view and the kinds of decisions and thinking that he and his colleagues are doing on this issue. I should point out that we're honored to have with us pretty much the full board of the, I don't know, is it called the board or the governing council or the whatever? Okay, it won't translate anyway. Of the Norges Bank. Scattered among you. We had a great exchange with them this morning, and we're delighted that they were all able to join us. Just for those of you who don't know him, Governor Øystein Olsen is now in his 8th year as governor of the Norges Bank. This is his second 6-year term. He was originally appointed in January 2011 and was reappointed last year. Immediately prior to joining the Norges Bank, Governor Olsen was Director General at Statistics Norway from 2005 to 2010, and previously was Director General of the Economic Policy Department at the Norwegian Ministry of Finance from 1999 to 2005. In other words, he's one of us. He's an economist, data nerd, public policy person, and so not only is he a leader on the global stage with his colleagues, but someone who one can really substantively talk to. And so I am very much grateful to have the opportunity to introduce him and looking forward to his remarks on Does Norway Save Too Much? Governor.
Well, thank you very much, Adam, for that introduction, and perhaps even more important, thanks for the invitation, or the opportunity at least, to be here today and to speak to you on a very interesting topics. Let me just add that discussions like this, because there could be a discussion afterwards, discussions like this are important and interesting. And also myself and also on behalf of the whole board, we are extremely happy to visit the Peterson Institute. You will know that Norway is a small open economy which was transformed by the discovery of oil on our continental shelf almost 50 years ago. Back in 1970, that was the year after the first discovery. Actually, the exact date was the day before Christmas Eve, 1969. Many of us remember the day very well. Before that, income levels in Norway were relatively low, actually, compared to other Western countries. But as you will see here, that picture has changed completely. Lower oil prices in recent years have reduced the relative income levels somewhat, but measured by GDP per capita, Norway still ranks among the richest countries in the world. Natural resources have been identified as a curse for some countries. For Norway, it has been a blessing. We have managed to transform oil and gas resources into real and financial assets. Luck has been supplemented with what I dare claim is a sensible, relatively sensible, at least handling management of the resources. At an early stage, it was concluded that the resources belonged to the Norwegian people. Large savings in recent years means that also future generations will benefit from the revenues. Direct government participation in the industry and an extraordinary tax rate for oil companies, currently at 78%, ensure that most of the resource rent flow into government incomes. All the revenue is channeled to the government pension fund global, or what is a better name, the oil fund. The sovereign wealth fund is an oil fund. The fund's capital is invested abroad. The annual transfer from the fund to the fiscal budget are guided by the fiscal rule, which stipulates that on average over the cycle, spending must be limited to the expected real return on the fund, currently estimated to 3% in real terms. And the general view in our country is that the management of our natural resources has been a success. Supported, I would say, that by the OECD and the IMF, which on different occasions have commended the framework. Still, there is an ongoing debate on whether current spending is too high. That is a discussion within our own country. Some argue that the planned consumption profile takes too little account of future obligations, in particular pension liabilities. Other claims that the estimates of the expected real return on the fund's capital still are too optimistic. In a couple of very interesting and recent papers by Bergsten and Gagnon, they are very recent and they are interesting, you present a different view. These papers point to high current account surpluses over a number of years and argue that Norway instead spends too little. And hence my presentation's title, is this the case? Does Norway really save too much? I will proceed by giving a few general perspectives on global current account imbalances, but I will then turn to this question of the title of how much oil producers should save and the background or reasons for the high savings in Norway. Well, the following reflections are you're very familiar with this, in particular that the international capital markets allows countries to decouple savings from investments. The ability to run current account surpluses and deficits at different times facilitates a globally efficient capital allocation. In addition, it may help to absorb country-specific shocks. Deficits allow countries to finance productive investments. Surpluses can generate higher returns than those available on domestic investments. And the possibility to smooth consumption is generally a benefit. And Norway is a prime example. Our oil history started with the country running significant deficits, as this diagram shows, enabling large investments without the need to cut consumption correspondingly. Deficits peaked at close to 12% of GDP in the 1970s, when the first investments in the oil industry were made. Since then, we have mainly run surpluses, but our net international investment position turned positive as late as in the mid-1990s, that is a quarter of a century after production began on the Norwegian continental shelf. As you know, global current account balances have increased since the late 1990s, as illustrated by this graph. If deficits persist over time, the financing of the debt can be challenging. High capital mobility could increase the vulnerability of high debt countries. Unbalanced developments can undermine support for open trade and flexible markets, in turn hurting surplus countries as well. In addition, both high deficits and significant surpluses may reflect policy and structural distortions that could hamper economic growth. So a current account deficit or surplus can thus, from both an individual country and global perspective, be either desirable or excessive, driven by distorted policies. To judge a given situation, we must therefore consider the fundamentals behind the imbalance. This is very much known to you here in the Peterson Institute, and I'm saying this because on the train trip yesterday here, I read the quite recent policy brief underlying in more detail some of the points I've just touched upon here. For producers of non-renewable resources, it is important to remember that although extraction of depletable resources is counted as income in the national accounts, these revenues are of a special kind. It would in many ways be more meaningful to view them as transformation of wealth from natural resources underground to financial assets abroad. And I think we all agree that we would expect such producers to run substantial current account surpluses during periods of production. As this graph illustrates, this has also been the case for many countries of this kind, in particular in the 2000s, when oil prices were high. In recent years, these countries as a group actually have been in deficit, while Norway has had a small surplus, barely visible in the graph. Exactly how much producers of non-renewable resources should save is a more complicated question. One potential yardstick is that savings should be sufficient to avoid the so-called Dutch disease phenomena. The phrase, as many of you will know, was originally coined to describe the strong decline of the manufacturing sector in Netherlands following the exploitation of natural gas resources in the 1960s and in the 1970s. There is a classical theoretical paper in this area by Corden and Neary from 1982, which describes the key mechanisms behind this development. They basically describe two main effects in an economy experiencing a boom in an extractive industry like oil, crude oil, or natural gas. The first effect is the spending effect. An oil discovery will increase export revenues, allowing higher imports over time. Normally, demand for non-tradable goods will, this is the spending effect, will increase, and non-tradable goods, the non-tradable goods sector, will require more domestic resources. As a result of higher labor demand from the non-tradable sector, the general wage level will increase, and the non-tradable sector will expand at the expense of the two tradable sectors. But the spending effect is only half the story. The second part is what Corden and Neary call the resource movement effect. Also, the oil-related sector will demand more labor, and it's profitable enough to extract the labor it requires. And as a result, wages will move further up, and the manufacturing sector will shrink even more. This crowding out of manufacturing is unavoidable if the benefits of oil and gas resources are to be enjoyed. But this process can go too far. The economy may find itself in a difficult situation when, at the point of time when the depletion comes to an end, when resources are exhausted. The structural changes in the economy then have to be reversed. Workers who have become unemployed must find new jobs in manufacturing. And this could be quite challenging and demanding. And in many ways, it is at this stage of development you can really assess whether a resource economy has escaped the Dutch disease or not. And in this sense, let me add that in the case of Norway, the jury may be still out. In a quite recent paper, Joe Gagnon argues that the necessary adjustment costs will be minimized if spending follows the permanent income principle, meaning that the expected real return of the resource wealth should be spent every year. On this background, he claims that Norway has saved too much and that spending should rather have been based on a modified version of this principle of the permanent income rule. The Norwegian fiscal rule just mentioned implies a more cautious spending path than this permanent income rule. The government spends, as I briefly mentioned, the expected return on its current financial assets, which is then significantly lower than the total oil and gas wealth. This fiscal rule implies that real spending will increase as long as production continues, that is, until all oil and gas resources are transformed into financial wealth. As the economy grows, spending as a share of mainland GDP will nevertheless fall gradually. This is illustrated in the present graph. The graph also illustrates that we in Norway have been able to cut through the very large income flows at the beginning of the present century. Since 2016, government spending has exceeded the net cash flow from the oil sector, meaning that we are actually presently running a primary deficit and will probably continue to do so for the foreseeable future. And in numbers, currently the transfer to cover the deficit, the non-oil deficit on the fiscal budget from the fund equals 8% of mainland GDP. Eventually, as delayed consumption increases, accumulated returns, spending according to this fiscal rule will also actually surpass the current estimate of the permanent income. So the discussion here, the real issue, is a question of timing. Has this spending profile been too conservative and the increase in consumption delayed for too long, as Bergsten and Gagnon claim? Well, my brief answer here, at least, is no. And my first main argument, I've already mentioned that by referring to Corden and Neary, is that the conclusion to spend the permanent income does not sufficiently take into account the resource movement effects just discussed. But I would add a couple of other issues, both intergenerational concerns, uncertainty, and also considerations about political processes may favor a more cautious spending rule. And I will use some time in addressing these issues in some detail in the following. Let me start again with pointing at some facts related to the resource movement effect with relevance to the Norwegian economy. Because as described in this paper, seminal paper of Corden and Neary, the resource economy is affected by strong structural changes also due to the increased demand for labor and capital from the extraction industries. Eventually, this demand from oil-related sectors will decline, and it will be necessary to reverse a downsizing of manufacturing. And to avoid Dutch disease, it could be argued that spending should be well below the permanent income reference, the permanent income rule, during this extractive period. Let me seek to strengthen those arguments by shedding some light on showing you some numbers, showing you the direct demand from the companies that operate on the Norwegian continental shelf. And start with an illustration referring to the fact that in our case, crude oil and natural gas are extracted from very large depths below the sea level. In particular, capital expenditure is high. The platform Troll A, shown here, provides a striking example. If most of it was not covered by water, it would dwarf some other well-known structures, which are indicated in the figure. In the years prior to the recent oil price fall, oil companies invested about as much as all other businesses in the mainland economy combined. Total oil sector demand amounted to more than 13% of mainland GDP in 2014, which is well above current government spending of oil and gas revenues, and also more than the estimate of the permanent income. It has been estimated that 1 out of about 9 jobs in the Norwegian economy was related to the oil sector. That is before the most recent fall in oil prices in 2014. The gradual development of oil and gas reserves in the North Sea has actually helped to create an advanced supply industry that has become, if not world-leading, so it's been able to export goods and also services to other areas in the world in specialized areas. The downturn following the oil price decline in 2014 has highlighted the strong oil dependence of the Norwegian economy. As oil sector demand plummeted, the blow to the economy was cushioned by a substantial increase in government spending. This room of maneuver in fiscal policy was provided by the significant savings in preceding years. Without, the recent downturn could have become more painful. Let me turn to intergenerational concerns, and which is another argument for relatively high savings. We have challenging future in this area. Like many other countries, we must cope with the challenges associated with an aging population. As we have developed a more extensive welfare state than, I would say, many other countries, the impact on public finances is significant. The pension system in our case is basically pay as you go, and healthcare is also funded by the government. An aging population will therefore weigh quite heavily on public finances looking forward. As the diagram shows, in the 1990s and 2000s, this demographic trend was different. During these years, the share of the population 67 years or older actually declined, reflecting low birth rates between the two world wars. But since around 2010, the long-term trend towards a higher old age dependency ratio has resumed. Public pension costs have shot up as baby boomers retire. The burden on the health and long-term care system is rather light just now at the moment, but this will change in coming years. And with an alternative strategy of spending the permanent income, we would have spent more of the oil wealth in the 90s and in the 2000s, when demographic costs for the government were low. The present fiscal rule, on the contrary, allows increasing spending of oil revenues in a period where age-related costs are expected to grow faster. A third argument, uncertainty. Third concern related to wealth management is just that a number of variables here are quite uncertain. Both oil price movements and the resource base are highly uncertain. Returns on foreign financial investments also fluctuate. In 2014, we were again reminded that future oil prices are uncertain. Prices have roughly been cut to half from the peaks reached in 2011 and 2012. Still, present prices are much higher than they were in the 90s, where in 1998 the nominal price dropped to $10 per barrel, while just a decade later, oil was trading at more than $100 per barrel. With oil prices closer to historical average, current account surpluses have been used substantially in the past few years. In 2016, our surplus was less than 4% of GDP, including the return on our financial assets. Trade was roughly in balance. The oil price has now rebounded somewhat, but it is not expected to reach the levels we saw a few years ago. At least in our case, we cannot rely on that. So the high Norwegian current account surpluses may actually belong to the past. And given the uncertainties related to petroleum wealth, a spending rule more cautious than the permanent income rule seems, in my mind, as a reasonable strategy. The fourth reason, or my fourth argument, political feasibility, political economy considerations. Let me spend some time on these kinds of reflections, because my point is that fiscal guidelines which shall function, they must be politically acceptable and they must be understandable to the wider public. Simplicity and robustness are important concerns. Rules that are not adopted by policymakers carry little value. The present Norwegian fiscal rule was introduced in 2001, 30 years actually after the first oil was extracted from the Norwegian continental shelf. This illustrates that it was not quite straightforward to arrive at the strategy for how our natural resources and the wealth should actually be spent looking forward. The need to decouple current spending from revenues was understood quite early, and potential mechanisms were discussed, but these concerns were not reflected in actual policy until the early 2000s. In periods, also all the oil and gas revenues, and more actually in periods, were spent. The fund mechanism was established in 1990 during Norway's deepest recession in the post-war period. At the time, it was not at all obvious that the fund would ever gain much value. The government ran at the time budget deficits and also a few years going forward. So that it was first in 1996 when a first deposit in the fund was made in 1996, reflecting that at the time the overall fiscal budget was in a surplus position. From then on, the value of the fund started to increase quite rapidly. Higher oil revenues and prices toward 2000s led to calls for higher spending. And the fiscal rule was actually introduced and decided as a response on these developments. A fiscal rule based alternatively on the permanent income from the petroleum wealth would also require agreement on what this number actually should be. Since 2001, we have seen large revisions in the estimated permanent income as oil prices and resource estimates have changed. The future development of the value of a fund is also admittedly uncertain, but at least the value of the fund at a given point of time and the actual return from year to year are possible to observe. It is also worth noting that the proposed rule, the decided rule, the actual fiscal rule, actually enabled a quite smooth transition from the actual level of spending on the fiscal budget at the time, that is in 2000 and 2001, while in comparison, a permanent income rule at the time would have implied a very large increase in spending back in 2001. So there is a practical argument and issue related here to the introduction of the present fiscal rule. In 2017, the estimated real return on the fund was revised downwards from 4% to 3%. This actually spurred no significant debate and was largely considered a more technical matter. And more generally, it's an important point that the present fiscal rule has reached and gained significant political or broad political consensus regarding the whole fiscal framework. And on that background, I claim that the framework has served us well for a period of soon 17 years, and it may continue to do so looking forward. So let me conclude and just claim once again that the Norwegian economy has benefited tremendously from oil and gas resources. Public and private consumption have increased. Solid public finances have provided a scope to make active use of fiscal policy when needed to counter external economic shocks. The accumulated wealth in the fund is now actually approaching 3 times mainland GDP, enabling a lasting annual income contribution to future welfare in the size of, say, 6 to 8% of GDP, mainland GDP, also in the coming years. The present guidelines allow temporary income flows to be transformed into permanent gains, benefiting also future generations. And as I seek to argue, the fiscal rule is simple and has been proved to be robust. Altogether, Norway's experience may serve as an example of why temporary shocks in general, and more specifically oil, discoveries of natural resources, justify deviations from a balanced current account. Deficits used to finance investments that generated high return have served us well. Finally, let me admit that I guess there is no such thing in the real world as an optimal spending rule. In the Norwegian case, there were definitely lessons to be learned during the first 2-3 decades of resource development. Still, over the years, and in particular with the present fiscal rule, I think personally that we have gained a reasonable balance. And by this, thank you very much for being invited and for your attention.
Thank you, Jessica. Well, thank you, Governor Olsen. That was thoughtful, and no, there are very few optimal rules, but there is good thinking, and clearly the rule you're following is the result of much good thinking. This is on the record. The governor's kindly consented to take questions and comments and respond. Obviously, first preference is to the topic of his speech, but other closely related issues on the governance of the Sovereign Wealth Fund, the performance of the Norwegian economy, and so on would, of course, also be welcome. The ground rules, for those who are not familiar, is Jessica is up front with a roving mic. There's a standing mic at back. Please either move to the mic or wait to be recognized. Either way, wait to be recognized. Identify yourself when making a comment. Since our colleague Joe Gagnon had done this policy brief, I'd like to ask him to make the first question or intervention, if I could.
Thank you. Thanks for coming here, Governor Olsen, and making such a clear and thorough presentation. If I may preface my question picking up on something you said, and it is actually the opening lines in the policy brief I wrote. The real story here is so many countries don't save enough. And we may have some difference as to whether Norway might have saved a little bit too much, but compared to the deficiency on the other side for so many countries, that's really striking to me. And I want to congratulate Norway on actually being a good example, even if you compare Norway to the most advanced economies who have resources. I think Norway stands out in managing them well for future generations. But that leads to my question. If we were to imagine resource exporters emulating Norway increasingly over time, and a bit of that happened in the latest round of high oil prices when some Gulf countries, Persian Gulf countries, did save a significant amount of the oil revenue, which they hadn't done before. So I think that was, for them, a move in the right direction. But if we did this on a global scale, the flows could be quite large. I mean, resource exports are 50 to 100 times around the world what Norway exports. So you can imagine how much saving that would be. We just came out of a period in which we had a very weak recovery, and countries strongly resisted any moves away from trade surpluses or into deeper deficits. My question is, how do you think that would unfold? What kind of responses should the world or international institutions take to manage such a shift? I mean, if you believe in Larry Summers' secular stagnation, you might worry that this could be an issue for demand management going forward.
Thank you.
Well, it's a quite demanding question, interesting question. Of course, I understand it. I acknowledge fully, if I understand your question correctly, that you sort of, if you transform, if you assume that other countries, even much bigger oil and more oil-dependent countries did the same kind of policy, that would change the world. That would be a major change to international capital markets, and I'm sure there will be some. Many of the arguments you have put forward in a very logical and consistent way, also in your papers, would be relevant, obviously. But I guess also if you take Saudi Arabia or any other countries which is not only dependent, they are 100% so to say dependent actually presently on these resources and the revenues, and they are sort of in my mind they're more or less consuming. They need the revenues as they come all the time. So I guess there will be very, very serious problems domestically in Saudi Arabia that will require enormous transformations within the country. Well, I'm not answering the question explicitly. I know that, but I acknowledge and I realize that it's not. There will be a completely different world, both within these producers, but also with a global perspective and with important impacts for capital markets. But there is back to one of my arguments. I think there is significant logic in if you say that for any country finding an enormous wealth, that wealth should be spent gradually. I mean, we all agree that actually Saudi Arabia and any country should save more, because the permanent income principle translated to Saudi Arabia will imply much more savings than they actually do now, because then they should decouple consumption for spending. So you will enter into the same kind of dilemmas that is implicit in your question. And I meant what I said at the end. There is no such thing as an optimal spending rule, but the basic principle that for a country which discovers resources, and when you extract the resources, the revenues are not of an ordinary kind. The logic that you should decouple production from spending, I think we all agree on that.
No, it's very helpful, and I would say that this actually turns out to be a very interesting topic for future research, which is maybe not optimal rules, but which different political economy or institutional arrangements of countries should determine how Norwegian they should be. And also perhaps, Joe, you could consider doing a writing on if all the rich resource exporters like Saudi became Norwegian, what would it do to the world? That would actually be, I think, well worthwhile. So there's the whole Kantian perspective. You should act as though you're legislating universal law, and the message seems to be from economics, don't do that. Anyway, sorry, that joke didn't work. Uri, if you could go to the back mic, please.
Yeah, with Dadush with the OCP Policy Center and with Bruegel. So the IMF and World Bank, it's a mantra when they speak to the oil exporting countries, particularly in the Middle East, but everywhere, that they should diversify into manufacturing. And this message is actually wide, or anyway, other export sources. And this message is often accepted by the governments. I'd be very interested in your view on the feasibility of diversifying into manufacturing and other export sources when you have a lot of resources like Norway or even more than Norway.
Thank you.
Well, I guess the question brings me back to the fundamental principles described, for instance, in the article by Corden and Neary, and I think it's if you find and have access to a natural resource wealth of a significant kind, of a significant size relative to the economy, and you want to benefit from that, you cannot avoid some squeeze of your tradition or your other competitive industries like manufacturing. But there is a major challenge to find a right balance, and for many of these countries, you hint at they are perhaps not very advanced in being industrialized, and then there is a major dilemma to have a squeeze of a manufacturing base which is already relatively small. And there are many dimensions here. You have one which I mentioned in my speech, namely that you have to, this development of squeezing the manufacturing, you have to reverse that development at some point when oil resources are exhausted. But I will also add another argument, perhaps. It's difficult for economists, it's difficult to argue what kind of industry that creates growth. But I think from intuition, if you should have some kind of manufacturing base. There is some where, due to productivity developments and dynamic developments in many areas in the country, which follows from having some base of manufacturing. So there is it's back to my argument, which I mentioned, that I think it's important to find the right balance. If you want to benefit from the resource base, you cannot avoid some industrialization, but this process should not go too far, or at least that is a dilemma.
Thank you. At the back, Mike.
Fred Bergston here from the Institute. Thank you, Governor, for a very thoughtful analysis and explanation of your situation. But there was one thing you did not mention that I want to ask about, which is the exchange rate. As you know, what led Joe and me to work on this issue in the first place was a concern that many countries around the world, all through the first decade of this century, had intervened massively in the currency markets, generated huge international imbalances, which had lots of adverse effects, including domestic political effects in this country. How do you all view the exchange rate in the context that you have described? Is it purely a residual that emerges from everything you do on the underlying part of the economy, including management of the resource revenues? Do you in some way tailor your foreign investments to limit changes in the exchange rate, kind of an indirect intervention, one might say? Explain to us how you inject that dimension of policy into your overall strategy and whether you feel that part of it has been successful as well.
Or you can say it doesn't matter to you if that's your choice.
Well, I fully understand. I realize that there are exchange rate developments in real terms. There are paths for the real exchange rates which are implicit in these models. But I'm not personally, and I think also on behalf of economists in Norway dealing with these matters. I don't think the exchange rate is in the front of the attention when we discuss wealth management. In that sense, when we started to introduce much more oil increased spending in the early 2000s, then I was the Minister of Finance. We were very much aware of the fact that that would imply a gradual, real appreciation of the currency. But the task was, and I think it is, all the time to find a sensible spending rule, find a reasonable balance between the things we have discussed now, and then you have to take the development of the exchange rate in real terms, which follows from that. I fully realize that this, I guess, is much different from the perspective of a major country. Norway is a small, open economy. We are used to we live with not fluctuations because we have actually the krone exchange rate appreciated quite markedly until 2013 in the period where we were facing in large volumes of oil revenues. Then, when oil prices went down, cut to half and more in 2014, we benefited what we saw as an advantage of having an own currency, which serves as a buffer and which smoothens the transformation to a development which has to be less oil dependent than the year we have left behind. So I'm not quite sure whether I answer a question, but we don't focus very much on the currency when we decide and evaluate wealth management issues.
Thank you. We have a question here, and then we'll go to the back mic. Jessica, here, please.
Angel Ubide from Goldman Sachs. Governor, thank you for your explanation and the details. Could you please elaborate a little bit on the spending rule in the following sense? Couldn't we argue that for investments that improve potential growth in the non-oil economy, there should be no ceiling? Because no ceiling on spending. You should be spending as much as you can to achieve the maximum amount of potential growth in the economy via public investment. And so the ceiling should only be for consumption, but not for investment. Is that the case? And if not, why?
Well, I understand fully your question. If you have theoretically, you should obviously, and let us disregard uncertainty, you should invest domestically until you have exploited all the investments with return higher than the national rate in theory. In practice, it's much more difficult, I will say, for many reasons. First, within the fiscal budget, I'm talking about should you spend the revenues for it's the government's revenues on consumption or investments. That is a discussion. in Norway, and it will be so going forward also. But I think one answer is that although there is a distinction between government consumption and government investments in the national accounts, I think when you are a politician, and especially if you work in the Ministry of Finance, you know that distinction is not strict. It's not strict. It's a classification of expenditures, which you classify it as investments when you enter the national accounts, but there is some logic that it could also be sensible to invest in human capital, say in education or even health services. The dilemma is that these expenditures are classified as consumption. So it's much more difficult to implement in practice, but the logic is there.
Thank you. At the mic, please.
Hi, Governor Olson. This is Shelley Hagan. I'm with Bloomberg. Since the latest rate meeting, data has shown that surveyed unemployment fell again, but credit growth slowed. What do you make of these mixed signals?
I'm assuming you mean data about the Norwegian economy.
Yes.
Thank you.
Now your question now, you turn to the conduct of monetary policy.
Yes.
Just to remind myself of that. Just a few days ago, we decided on the target, the policy rate, and we announced our plan for gradually increasing the rate, given the outlook as we saw it. Then from that on, there will be new data coming in. I will refrain from commenting on what that implies for the target rate, for the policy rate, until at least May, where the board shall make the next decision, and also postpone it to June, where we present another monetary policy report with new forecasts also for the target rate.
Okay.
I hesitate to answer, yes.
Okay.
Ted Truman here at the Institute. So this may be, I'm sure this is something you've thought about. So with your sovereign wealth fund, which has 300% of GDP, right, and is close to the largest one in the world, at least as far as we know. Some data are not all there, but I think on the order of $1 trillion. You are a major player in international capital markets, and you have to make choices there too, in some sense, in terms of the allocation of the fund. You and your colleagues are allocation of your fund in different in the assets of different countries, and I'd be interested to hear you say something about how you think about that process. I'm aware that you have rules, if I may put it that way, guidelines, which you might want to articulate, explain to us, but you have changed them over time. So one question is sort of how you go about thinking about the asset allocation in a geographic sense, because that picks up again on a bit on what Fred Bergson was asking. That has implications, one would think it has some implications for exchange rates and relative rates of return on assets denominated to different currencies.
Well, you're very right in your question. The Norges Bank has I guess we are somewhat different from most other central banks in the sense that we have a major fund invested abroad. But I have to add that there are quite a number of central banks which have accumulated currency reserves for different reasons, which are in the same league, and where the allocation of their fund are not restricted to bonds. There are some central banks which also invest in equities. So we are not that different. But yes, especially in light of the size of our economy, we are special, and we have, as you indicate in your question, we have developed a special department within the bank which is doing this job for the Minister of Finance. It's not a central bank task because we haven't the same. We're not independent in this area. We have a mandate, quite detailed mandate, given by the Minister of Finance. It's important to underline that all the important parameters which decide the expected return and also the risk profile over time are decided at the end by the ministry, or actually anchored in the parliament reasonably. But I should also add, often after good advices, sensible advices provided by the central bank. And we could, especially Egil Madsen, who's a deputy governor with this as a special responsibility, could elaborate on that. But you will know that the allocation, the mandate, and the allocation has been developed over time in different ways. The most important recent decision was, I guess, to increase the equity share to 70%, a decision which we are about to implement. That's the most important one. But there are a number of the executive board, which is here among the audience. We use significant resources and part of our time on the fund, which we should.
Thank you. Any other questions for Governor Olson, please?
Thank you, Governor. David Short with FedEx. I'd be interested if you have any thoughts you could share with us about the approach taken, for example, in the Gulf, where Saudi Arabia is putting $500 billion into the new megacity Neom, and another example in the United Arab Emirates decades ago, they made a strategic investment to develop their aviation sector, something that markets probably wouldn't have justified, but now, 20 or so years later, Dubai has surpassed Heathrow as the world's busiest international airport, and I understand Emirates, which produces audited financial statements, is a very profitable airline paying dividends to the government of Dubai. So is that sort of strategic investment something that Norway would ever be in a position to entertain?
On that question, on that specific question, I couldn't answer, and also I will not answer as chair of the board specific investments which we have made or could enter into in the future.
Okay. Any other questions not about specific investments that could be entered into the future? Yes, please.
Thank you. Thank you, Governor. This has been very interesting. I'm Meg Lunsager. I'm at the Wilson Center and previously was at the IMF and the U.S. Treasury. My question for you comes back to your comments on political economy. Given the huge increase in per capita incomes, the wealth of Norway, do you have more domestic pressures to be more generous in terms of external donations, whether it's through the UN or bilaterally or other institutions? I sense from what you said the answer might be no, but I'd appreciate an elaboration on sort of how that's viewed over the last, let's say 20 years when Norway's gone to being, one of the most wealthiest countries in the world. Thank you.
Yeah, it's a very relevant question. I think I said something like that. Broadly speaking, there has been broad consensus. That's the main picture. I think it's correct to say that. But of course, within the country, there are different camps. There are NGOs. We have a free press, like you. And there should be discussions, and that has been the case all the time to invest more, take more of the fund, and invest more domestically, with understandable arguments, but with some practical problems related to the proposals. There are people suggesting to increase even more the aid that we provide to internationally. So there are a number of discussions and proposals, But that does not come into conflict with, I would say, with my general view, namely that over time, and when we look through all the discussions, there have been relatively broad consensus on the management model, and also on the fiscal rule. I should then add one dimension, which is important, it's quite extremely interesting for us working in Norges Bank in particular, namely that there has been a recent proposal from a commission led by my predecessor, Svein Gjedrem, a governmental appointed commission, and they proposed, they modernized the central bank law. That was their main task. But then they also, as part of their mandate, they were asked to propose a governance structure for the bank, including the fund, and their main proposal was to move the fund out to a separate governmental institution that is out of Norges Bank. That is a major issue. And I guess there will be a major important discussion within Norway and at the end in the parliament.
Very good. Okay, I think that brings us to the end of this session. I'd like to once again thank Governor Olsen and his colleagues from the board of the Norwegian Central Bank, the Norges Bank. As I mentioned, we've been fortunate to be in a relationship with the bank and with Norges Bank Investment Management. This is partly disclosure, but also proud gratitude. More importantly, we've been delighted, as exemplified by Joe and the bank's exchanges in recent weeks, to have a really substantive discussion of these issues and learn from Norway for the global system and for other countries. And finally, I should note we have a distinguished Norwegian business person, Herbjørn Hansen, on our board of directors and maintain an interest on Norwegian affairs through that. So the door is always open here at the Peters Institute for our friends, and we are very grateful that you brought so much substance and insight to us today. Thank you very much.
Thank you, Adam. Thank you very much. Again,